So how is everybody doing today? Everybody happy? Everybody good? I hope. Everything good in the... Let me know if you have any questions as we go. As you know, I like to do a couple of these sessions a month and so on. Markets are volatile, huh? What ones are you talking about, Raymond? It's been an interesting time, obviously, in the markets with a lot going on in the world. And I thought I'd be doing the little live market analysis. My name is Sam Evans. I'm of Pinnacle Institute. And, you know, Sam Seiden and myself do like to come here and spend some time with you a couple of times a month as well. And everybody's kind enough to have us on here. So I can take it in the Q&A or the chat. So everybody, you can either type in the Q&A window or you can type in the chat window if you have questions. One of the things we pride ourselves on is using basically the Pinnacle method for trading and investing. The Pinnacle method is the original supply and demand methodology. And we are proud of how it works and how we use it and so on. In fact, I just came off of a session right now, and I'm going to just resume this. Can everybody see the charts? Can everybody see the charts right now? Should be seeing my single swim charts for the S&P 500. Yep, great. So, you know, we're a big believer in letting price, you know, come to us and letting price come to you. I literally just finished a session that I start to do twice a week when I trade the US Open, 9:15 to 9:15 to 10:15 or 10 a.m. We just got triggered long on the ES here at 396104. Now the market went as low as 3961, so we literally got it to the tick. Just hit our first target off the back of the news. And when I go through the zones with you that I'm going to show you, this is a day trade here. I'm going to be looking at things like big picture because there's a reason for me telling you this as I go into these markets and talk about it. Today's session, I really want to talk about what to expect coming into the next year. What are the key levels I'm looking at going into, 2023, and we're getting very close to the end of 2023. Everything we show you, everything we do works on different time frames. You know, if I look at these charts here, I've got daily charts up, 2-hour charts, 30-minute charts, and 15-minute charts. For the purpose of the trading I was doing today, we were looking for short-term moves in the market. So we just hit our first major target here and we're looking for more upside. Whether it goes higher or not doesn't matter. We got paid off of this area here. But the structure of this particular zone here met the requirement for an opportunity to get long. And that opportunity to get long was looking for a good, strong move away, very little time spent in the area, and playing basically the extremes of the market. And when you're in the subject of volatility, guys, you know, you have to play those extremes pretty close, as best as you possibly can, right? Playing those extremes as best as you possibly can is the key. And when I talk about that is where too many traders go wrong is they don't let price come to them. We only have two trades that we like today. One down here, one up here. Now, we've got higher levels, which the market may get to as well. But the reality is it's these two levels. And that's a day trade. Well, that same principle I'm talking about with you right now is what we're going to look at when we go to the larger markets that we're going to look at going into 2023. There's only going to be key areas. I have to see this or this. I'm going to assume that this market is going to, let's just give this some more space over here. I'm going to assume this market is going to stay pretty much in this range until this area of supply here is broken, or this area here of demand is broken. I'm going to play this range. That's what the market's telling me by understanding, you know, imbalances, fair value, and so on, okay, which are the key principles of the Pinnacle methodology, you know, doing these areas. And like, so I'm doing this on, it's tougher when you're on a short-term trade, but we do it on long-term plays as well. Okay, you can do the same principle on long-term plays. So if we go over to here, let's go and look at another trade that we just had, and I'll talk you through it, and then we'll apply it to some new levels. Going to go over to here, the futures markets, okay? And this is the beauty of it. You know, we're looking at gold here right now. We had a great short on gold that triggered here. Just got a whiff of a long on these key areas here. Notice where all these areas are. Price extremes. We were short at supply here, long at demand here. shorted supply here, just missed getting the demand here. Notice we're avoiding all the areas in the middle. And going into 2023, that's what you've got to do, is you've got to avoid all the areas in the middle. In fact, and make that your new habit moving forward in all of your trading, i.e. we've been waiting on crude oil for a trade for a while. Well, was it worth it? Yeah, we've been having a lot of chop on here. Notice how the market almost came to this area here, but this was a trade that triggered yesterday for us, a long trade at 73.83 long, which we've just about to hit we just actually hit our target on today at this opposing supply level. Now, was it worth waiting for this area? Of course, because what was it outside of? It was outside of this fair value chop. And thinking about this, when you have classic like support and resistance areas, which most people are looking at, that's all well and good, right? But how many of you seen when it goes out a little bit lower and then turns, or it goes out a little bit higher, then turns? We're always looking to get outside of those regions, to get price to stretch as far as it possibly can outside of the normal areas. And this market's incredibly cheap right now. So from a very objective perspective, there's a lot of room for this to get up a lot higher, this crude oil market. And this is why this 79.85 area is our first target of many. You understand? So, you know, with knowing that we've got to go to extremes, let's take it back to the dollar index and start looking at what the dollar index is doing right now. Okay. And with what the dollar index is doing right now, what are the key levels that we anticipate are being triggered right now, and what we need to start analyzing here? Because if you can understand the dollar, you're pretty much going to understand most things. Like today, we opened the market looking at the dollar today. We started our session looking at the dollar, and we've been very aware that we've had a couple of big buying opportunities have been coming in the dollar, but we're well off. We've stalled a little bit, and we're not at supply, we're not at demand, which creates in itself choppy situations on the dollar, which in turn will likely create a sloppy situation or a choppy situation with the S&P as well. Now, do you notice that we're in a little bit of a choppiness right now? And Raymond, you said, yeah, volatility, choppy markets on both sides. Look at what the dollar's been doing for the last couple of weeks, 2-3 weeks. Not really going up, not really going down. You see that on the daily charts? Now, if you look at that, I want you to look at that picture. Really zoom in and just look at it there for the last couple of weeks, that daily chart. Now, what I'm going to do is take you to a chart of the S&P as well. So if you look at that chart there, then I look at the S&P 500. What's the S&P 500 been doing? What's the S&P 500 been doing? Has it been clear, or is it also a little indecisive right now? You tell me. And I'm looking back, look at the dates from early November here to where we are today. What's it been up to? Anyone? Sideways, good. And he's sideways as well. So let's just look at that again, right? S&P sideways since about what? November 10th. You see that? November 10th? Sideways since November 10th. Dollar index. Go back over to here. What's dollar index been doing? Pretty much sideways from November 11th. In fact, what we could do is leave that on there. Let's do this. Let's do this. We can see it a lot clearer this way, right? Look, there we go. Sideways action there. And I'm going to unlink this. I'm going to put this on a daily chart. And I'll put the SPY over here. Let's just clear all these chart levels off. Don't need them on. Bang. There you go. How much better is that? All right. So now, if you look at these two charts, and this is where people go horribly wrong. They look for absolute perfect things. We've been in an upward trend on the spiders here. We've been in a downward trend a little bit on the S&P here. Okay. And now we're basing. They're an inverse to one another. Do you see that? Now, by looking at these inverses, looking at these structures that we can see, looking at these relationships between the dollar and so on, you know, to me, you know, while the S&P's been going down, going up, risks come off and risks back on. Risks come from basically going back into the S&P 500, which means the money's been coming a little bit out the dollar. Because if you want to buy one of the safest assets, and it's scary that one of the safest assets in the world is US Treasury bonds, but they are one of the safest ones, which is kind of scary when you think about it, because it's not like the US economy is so much better than everybody else's, but it's probably the, you know, the shiniest or the cleanest lump of, you know, the diamond in the rough, should I say, is the way I would describe it. Okay. It's the best of a bad situation, set of bad situations. Point is, to buy US dollars, or to buy US bonds, should I say, you need US dollars. As a flight or a regard for safety has come, and as more and more people, you know, want safety in the markets, they're buying into bonds, right? So when the S&P was going down, the dollar was rallying. So if we clean this off, look at this. Go on the weekly charts for a sec. This is the year, man. This is going to make a lot of investors unhappy. Let's look at 2022. 2022 on the S&P. It's a pretty rough year, right? Let's look at 2022 on the dollar. This is a weekly chart now. In fact, 2022 alone, look at that. Been a great year for the dollar, right? So you see the inverse relationship between the two, guys? So now we're at really key levels, aren't we? So let's look at these two charts side by side and take a look at what's going. Now, I look at this chart and there's two key areas that are interesting to me. I see that we're in an area of supply right now. So I'm going to go ahead and draw that on for us. I'm going to go ahead and draw that on, right? And these are the key levels. There is a method to what I'm talking to you about here. There's a reason I'm discussing this. We're in a bit of supply here. Notice the drop, the base, and then the drop that created a new low. Notice here the drop, the base, and the rally that created a new high on the dollar index. Let's go mark that off. Does everybody see that? So what we've got is S&P supply and dollar demand. Okay? Dollar demand. We also have levels a little bit above them as well, which to me quite interesting. This is a very interesting key. This is what I call a pro gap. This is a level I've been really eyeballing. I'd really like to see the S&P get back up to. Is 422.14 to 431.73, which is an unfilled gap. That unfilled gap is a sign of a major imbalance because we've been an uptrend and then we had what we call a pro gap down. If you're wondering what pro gap is, come to one of our workshops, come join us for a week with Advanced Elevator Pinnacle, and you'll see more of that and how that all works out. But underneath that, we have yet another level on here that to me is kind of important as well, around the same time, which was great. And let's look at when that was created. That was July time. That was around the same time, right? So you can time these markets pretty efficiently together. So we've got a secondary supply level here, and here we have a secondary demand level here, all right? So now what I've got are my key areas that are very, very interesting. Now, if you're a trend follower, which I'm sure some of you are, what is this a downward trend? Lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. We are still making lower lows and a series of lower highs on the S&P, and surely we're still making higher highs and higher lows. Now, obviously, what I am going to be looking out for is if this fails, we could come to here and then we could rally again, right? That's why I have the two areas. That's why I have the two demand areas and I have the two supply areas marked off. See, what a lot of people will do is if one demand area breaks, they go, oh, the trade's over and off we go. I don't operate like that. The whole idea of markets, I feel, is to fool you. The whole idea of markets is to sucker you into thinking that something's going to happen and then it doesn't. So if this area of demand here fails, let's call this demand zone 1. If D1 fails, I'm going to be then looking for D2. If S1 fails, I'm going to be looking for S2. Okay? These are the near-term areas. Because then if we actually take out S2, then we've done what? We've taken out and put in a brand new high. Then I've got to expect that then we're going to go higher still on the S&P. If we take out D2, which is this area here, then I'm going to expect that we're going to end up going what? Lower as well, because then we would have taken out two key demand areas on the weekly chart on two key supply areas. So the timing is beautiful with these two markets. Because again, let me stress this to you. What is riskier, bonds or stocks? You know, think about this for a second. You've got the bond market. Under normal conditions, bonds versus stocks, right? Well, trying to do my best to write here. Bonds versus stocks. Typically, the riskier asset is the stocks. A lot more volatile. The safer bet is the bonds. Why? Because bonds are guaranteed. As long as the money market doesn't, as long as the government doesn't default, bonds are a guaranteed fixed income product, carrying a lot less volatility and a lot less risk. That's why you get this inverse relationship. People go, well, why is the dollar that? Well, here's the thing. Also, the more expensive the dollar gets, the more you have to effectively pay for your stocks, but you also need to buy dollars to buy US bonds, right? So a lot of people seem to forget about this. And on top of that, where are US bonds right now? US bonds have been, where have interest rates been doing for the last 30 years? Going down. But now what are interest rates doing, guys? What are interest rates doing? Let me ask you a question. What are interest rates around the world doing right now? Are they going down or are they going up? They're getting up now. Interest rates are increasing, aren't they? So again, if you want to sell US bonds to somebody, you want to get paid in US dollars. They're not going to accept euros. They're not going to accept pounds. They're not going to accept Swiss francs for that. So in turn, you have to buy US bonds with US dollars. And if we take a look at these two key areas on here, let's bring another chart on. And let's put in this. And what we're going to do is bring another chart on into the mix. I'm going to just remove volume. Don't need that. And I put this on a weekly chart. Now, this also helps us. Look what's been going on this. This is the 10-year notes. This is 10-year notes. 10-year notes have been going down for most of the last year. In fact, they've been in a longer term downward trend than anything else. These are US Treasuries, all right? Also in a downward trend. Well, that is lining up beautifully with what's going on here, because here's what this is. US Treasuries, we go full screen on here, have an inverse relationship with price. So this is price on the right-hand side, right? As the price gets cheaper on bonds, as the price itself gets cheaper of the bonds, it means interest rates are going up. Think about that. They have an inverse relationship. So when rates are going up, the price is going down. Does that make sense? So that downward trend is as bond prices are going down, it means rates are going up. What are rates doing? Going up. That means there's a whole lot more potential for us to go a lot lower. And if you look at the monthly chart, and I put on the full amount of time that I can put on here, you'll see that we're at 109. We have got a ton more space to go lower on here. We got loads more room to go. So this also lines up quite nicely as well with key levels, because we're having a little respite right now. But I look at this weekly chart, and guess what I'm seeing? Another key supply zone right here on bonds. I'm seeing another key supply area on bonds right here. I'm seeing two key supply areas on bonds right now at 11.14 to 11.16. Now let's look at those sideways. Let's start thinking about this for a second, okay? We would expect the dollar to go up, bonds go down, S&P to go down in that respect, okay? So there's a whole lot of pressure you know, on this particular market. So I'm looking at all these key levels kind of lining up at the moment and thinking to myself, yeah, if we get a good push on this, we're probably going to get a good push on this. Does that make sense? On the dollar, on the S&P. Okay. Now, these ones here have normally had an inverse relationship over the long term, a very good inverse relationship, you know, also. But the problem is, there's a lot of people say, well, I've heard that the bonds have an inverse relationship with stocks. So if they're going to go down, this is going to go down. Yeah, but the bonds are so overbought, guys. Bonds have been so overbought because interest rates have been going down for 30 odd years, right? So with that in mind, you know, you can't really use bonds as an inverse relationship with the S&P anymore. It doesn't really work quite as effectively. What it actually means is this is more of a fundamental play. You know, if interest rates keep going up, bonds are going to keep going down. And you're going to have to keep buying dollars to buy bonds, which is going to put a ton more pressure on the S&P itself. Like, think about the dollar as a safe haven. It's like the safest place around right now. Okay? So, you know, that's a very, very important thing. You know, where else is potentially a safe haven out there? Okay? The dollar, you need the dollar to buy everything. The dollar's like kind of the key influencer right now on this. You've seen a little bit of an unwinding with gold as well. So for now, what I'm trying to do is really focus on the two major ones. And to me, these are the key levels where we're at right now. Now, what I would also say to you is going into this year is expect that these key levels here on the dollar and the S&P are going to be the ones that if we can start closing, and I'm going to give you some numbers here. I'm going to give you some numbers. If we can close above, I'm going to color these for you. So I'm not going to just say, oh, if these levels hold, I'm going to give you a couple of numbers to look out for. Sound good? If we could close above 107 cleanly on this weekly chart, that would be a very bullish sign on the dollar. If we can close above 107, that to me would be very, very bullish. All right? That would be my sign, a close above 107, that we're going to go higher. Does that make sense, guys? If we close below in the coming weeks, $394.64, if we get a good healthy close below 394.64, I'm expecting lower prices on the S&P. So if I could ideally get a close above this area and a close below that area, I'm going to expect a continuation of upside momentum on the S&P, on the dollar, and then I'm going to expect a continuation of downside momentum on the S&P. You know, the biggest plays this year really that we've been looking at over the course of, you know, this last year on the S&P is shorting the rallies. Shorting rallies on the S&P and buying pullbacks on the dollar. That's what's worked out pretty good. I'm going to keep playing it like that until the market tells me otherwise. Does that make sense, guys? Going to keep playing it that way until the market tells me otherwise. They're our key levels right now. They are the ones that we're looking for. Now, in turn, obviously, what would this do with the S&P? This would lead us to shorting opportunities on other markets. This is where you can start looking at your individual stocks and so on. You know, some of your big stocks. You know, you want to find the weaker stocks, you know, your Apples of this world and all of those markets. You know, you look at Apple over the last few weeks. Again, look, it all lines up. Apple's one of the highest correlations. It's one of the strongest stocks. This is Apple on the right-hand side, right? And then you look at it over here, and then you see on here that, you know, Apple over these coming weeks is not holding up quite as well as it should. I mean, it's starting to show weakness while the S&P is at weekly supply. We just ticked weekly supply a couple of weeks ago. We're breaking down from those key areas again. I'll give you a key area on Apple that we should be looking at right now. Okay? We should be looking at this area here. This 48.11. If we start to break down lower on here, we're going to see lower prices on Apple. We're going to see a rally in the dollar again. We see a rally in the dollar. What does that mean for currencies? What does that mean for the currencies? Look at the euro. Look at this. Perfect. We're in the euro. We are in a key area right now on the euro. We're in a key area on the euro right now. We are in a short area. There is a ton of downside momentum on the euro. This is lining up nicely with the inverse help of the dollar and the inverse help of the SPY. Let me give you the key level for the euro I'm looking at right now. Key level I'm looking at on the euro is this. $103,227. Closes below that area. We're probably going back to parity again. I have no problem making calls. I have no problem looking at it. People always go, well, if this happens and you could, that's what I'm looking for. If we close up below 103.22 on the euro, based upon the cross asset analysis I'm doing with the inverse action of the dollar and the inverse action of the S&P, I'd expect lower prices back to probably at least 99 cents on the euro USD. Okay? On the pound, let's go through a couple more. Let's get through a few more. I might have these already set up. Great. Let's clean them up. This is the level that's lining up right now. We're in weekly supply here. Now, I will say this. The pound has been showing extra strength. I would remain bearish on the pound right now, based upon where we are. Based upon where we are, if we get a close below here, my next key level on the pound, I don't like the pound as much right now. I know that sounds very unpatriotic, but I'm not as keen on it from a chart perspective. But we've got a little pound is one of the anomalies. But 188.62. That's my key level here. I'm expecting dollar holds. This is going to drop. S&P is going to go with it. Let's get through a few more. Let's see where the Australian dollar is. This is setting up beautifully. I'm going to show you the Australian dollar and the week as well on here. Let's clear off our drawing set. Here's where we are on the Australian dollar right now. We've tested weekly supply. Where's our line in the sand? The Aussie is not in a nice place right now. If you're aggressive, you're already short on this right now and have been. We break 66.71, close below that. We are going down to at least 64.23. Are we at supply right now while the dollar is at demand? Yes. And even if we poke our head a little bit higher, guess what? We've got more supply to the left-hand side to deal with. Does everybody see that? New Zealand dollar just recently triggered. There it is. I've got to clean these charts up. We actually had some daily areas that just triggered on the New Zealand dollar a couple of days ago. Take a look. We just filled up a little gap from here. That's very bearish. We had a pro gap on the New Zealand dollar. This was our supply zone, 62.57, 63.12. We looked at before the major news last week. What are we looking at right now? We're in a supply on the New Zealand dollar. There's our line in the sand, 61.53. We close below that. We're in a lot of trouble. All of these are signposts. You have to put prices in using supply and demand methodology. You put prices in which are your go-tos. You say, hey, that's what I'm looking for. If this, then that. If this, then that. And then, you know, it all hinges really to me upon how the dollar performs for the rest of this year. You know, you want to look at assets of the last year. Every asset to hold, you've been crushed on. Every asset you could have bought and hold this year, you've been crushed on. S&P, you've been crushed buying and holding S&P. By the Qs, you've been crushed on the Qs to buy and hold that. Crushed. The Russell, crushed. Right? Gold, sideways. Crude oil was great, now sideways, right? Not doing a lot. What is the only asset that has truly bought, held, and done well? The dollar index. People invested in the dollar. Big institutions invested in the dollar. That is why it all comes down to the dollar. If the dollar holds, if the dollar gives us a sign, everything else will give us a sign afterwards, right? And when you want to look at like weakness in the market, you know, you look at the QQQs, man, this market, a lot of pressure. Tech's under a ton of pressure right now. I mean, the Qs to me is not shaping up well. Here's your line in the sand on the Qs. I'll leave you with this one. Your line in the sand. Tech has been getting crushed. And, you know, I look at my line in the sand on this and look, we haven't even managed to get to our weekly supply area on the QQQs. And we got the same ones on here. This is the weak one. And again, if this week we close below this 283.4 area, that's just leaning more and more to a retest of 265 for me. You understand? All these things just lining up, lining up, lining up. Yeah? So, you know, whether you're, you know, long-term, whether you're short-term, whatever it is, you should always have these lines in the sand to target and help you. I'll leave you with those kind of numbers on there. I'm just going to put my S&P numbers on there. There you go. There's my weekly areas. But, you know, I wouldn't be surprised to see a little bit more sideways action over the coming weeks leading into Christmas, whether this thing's going to break higher or lower. These are big key areas. I would, on all of these markets, play both sides right now. I am bearish outlook based upon what this dollar's doing, and these are the key areas I'm looking at, the key demand and supply areas. But you have to be open to both sides of the trade. You know, I go look at this today. Yeah, I'm bearish on the market, but look, I was a buyer today as a short-term trade. We just hit our first major target on this at 39.80. Now we're looking for it higher at 39.94. You can't let your long-term outlook influence your short-term outlook. Think about what your goals are. Guys, if you like what I discussed there, if you enjoyed what I showed you, my best advice to you is come check us out. We hold regular workshops. Go to pinnacleinstitute.com. We hold regular workshops weekly. Twice a week, we hold regular workshops. I'll bring us over there. Go to our website here. I'll bring this over for you and show you. I can pull it up. For some reason, my charts are just not working. There you go. Hit to register now. So go to pinnacleinstitute.com. You see all of our free trading investing lessons on here. You can register for those. You can also get started with our workshop here. Just click on here. And here's the dates. Here's our coming dates come up. Got one tomorrow at 11 a.m. All hour and a half, 11 till 12:30. Saturday, 10 till 12:30. Wednesday, 11 till 11:30. That should be till 12:30, by the way, on there. But here's what you'll be learning about. If you like what basically you saw, come check us out. Come to a free workshop. See if you want to take us and spend a week with us doing a little bit more on there. Guys, thank you for having me. Apologies for the delay in the learning, but hopefully, you know, you got something out of that. As always, FX Street, thank you for having me. I appreciate being here. I'll be back again next month. Next month, I'm doing a bit on basic options with currencies. So I hope you can come and join me and check that one out and have a bit of fun with that. In the meantime, enjoy the rest of your November. Stay safe out there. And I'll see you guys next month for your our next FX Street session. FX Street, thanks for having me. Thank you, everyone, for taking the time to be here. If you listen to the recording, thank you also for taking the time to join me on that as well. Have a great rest. Yeah, oh yeah, look, there's the link for it as well, how to trade options. Very simple introduction to options. If you've never done anything with options, think about this as a basic intro to options and how you can start looking at them. All right? Have a great rest of your day, all right? You be well. Thank you very much. Have a good one. Take care. Bye-bye.